Over the past decade, the world's wealthiest 1% of the population have amassed an astonishing $42 trillion in new wealth. And this now is 34 times more than what the entire bottom half of the global population gained. And this just really, to me, highlights a dramatic surge in inequality. This information comes from an Oxfam report that was released as the G20 finance ministers gathered to discuss global economic issues last week. The most poignant quote on this topic comes from Michael Taylor. He's the founder of the Australian Independent Media Network. He says simply, "That is disgusting." Now, I am a big free enterprise guy. I love it when people work hard, create massive sums of wealth from their hard work, their dedication. But no doubt, he is correct on this one. Oxfam's findings, they reveal that billionaires now pay less than 0.5% of their wealth in taxes. This, of course, contrasts with the much higher rates that people like you and I pay the general population. Max Lawson, he's Oxfam's head of inequality, and he says inequality has reached obscene levels, and until now, governments have failed to protect people and the planet from its catastrophic effects. Now, amid these concerning trends, there is a push for a global tax on billionaire wealth. And economist Gabriel Zuckman, he suggests a 2% minimum tax on billionaire wealth. That would generate $250 billion annually. Then he says these funds could be used to support critical needs, things like climate change, education, healthcare. Now, last week at the meetings, the political will of the G20 governments to implement such a policy was tested. Despite acknowledging some of these benefits that we've just talked about here, the preliminary reports are that the G20 leaders will delay any concrete actions, and instead they're opting for prolonged research into taxation and inequality. France, Spain, South Africa, Colombia, and other countries, they are supporting this tax on the super rich, but Germany and importantly here, the US, they're against the idea. To sort of wrap it all up here, Oxfam's food policy expert Eric Muñez, he emphasized the need for deep structural changes to tackle these issues comprehensively. According to a recent report by Urbanation and CIBC, over 80% of Toronto condo investors are losing money. The rental income that they're generating isn't enough to cover the rising costs that are associated with mortgages and property ownership. This financial strain is having a huge impact on the market, and we've seen that here. What we're seeing is investors are becoming more hesitant to purchase pre-construction condos, properties that haven't yet been built, and there's a lot of those out there in the market. And in turn, this reluctance, it has led to a dramatic drop in sales, now the lowest in 27 years for the first half of 2024. The market for these condos is described as being in recessionary territory, and this is something that we haven't seen in decades. Also, the numbers paint a pretty dire picture. The average monthly ownership cost for a new condo in the Toronto-Hamilton area is now $3,250, 21% higher than last year, 54% above what it was in 2021. Meanwhile, the average rent for these condos has reached a record $2,700 per month, not enough to cover the escalating expenses that the investors are seeing. As a result of this, 81% of investors who financed their condo purchases this year are finding themselves in a negative cash flow position, losing on average $605 a month. So what's happening now is this imbalance is pushing many investors right to the edge, and they are leading a lot of them to consider selling their units. And this potential increase in available condos for sale could lead to further price declines, particularly in a market here that's already seeing quite a flood of cheaper already built condos that are listed for sale. Benjamin Tal, he's the deputy chief economist at CIBC, and he warns that those who own multiple units are most at risk. He says the main correcting mechanism will be to sell, and he added that this would put further downward pressure on any resale prices, widen the gap between the pre-construction and already built units. The situation is also having an effect on the broader housing market, with new condos making up over 35% of the rental stock in the city right now. This discourages investment in pre-construction units, and it could lead to fewer housing units being built overall. In the report, Urbanization notes that in the past year, developers have delayed launching 76 projects that could have added 24,335 condo units to the market. Despite a recent pullback in the sector, the technology space has continued to deliver strong growth in the first half of 2024, largely led by the performance of the biggest names in the sector. Then, of course, we've seen artificial intelligence playing a big role in that growth. Apple has passed Microsoft as the largest public company on the planet after laying out its generative AI strategy. There's a ton going on in this space. I want to thank Harvest ETFs for their support in today's video, and make sure you know about the Harvest Tech Achievers Enhanced Income ETF. That's HTI. HTAE on the TSX. This ETF is designed to deliver higher income and growth opportunities by applying modest leverage to an investment in the Harvest Tech Achievers Growth and Income ETF. That's HTA on the TSX. So this means that you get access to the same portfolio of these large cap tech companies with higher income every month. To learn more about the opportunity, click on the link in the description. Also now, a quick word from our Investing Academy. Hey folks, as many of you know, in addition to this YouTube channel, we also have the Investing Academy. This is our online platform, and we work with Canadians of all ages from across the country to help educate about investing and financial issues in general. The course material is designed to take you from a raw beginner to a fully confident investor.
Now it's time to dedicate an entire module to the topic of dividends, because as I told you guys, they are that darn important.
I will put a link in the description of this video and maybe check us out. Now back to the video. According to David Rosenberg, who is the founder of Rosenberg Research and Associates, last Wednesday's Bank of Canada decision to lower its policy rate to 2.5% from 4.75%, that is seen as a correction of a previous policy misstep from last year. He expects more rate cuts to follow. In the report, he highlights that despite this adjustment, the Bank of Canada still has a long way to go. He argues that the appropriate rate, given the economic conditions that we're seeing now of excess slack, should be closer to 2%. So that's a long way below where we are right now. The bank acknowledges that while certain sectors like shelters, select services are experiencing stubborn inflation, overall economic conditions don't support sustained high inflation. The bank's recent cuts are portrayed as an effort to realign with the economic reality and slow growth of urbanization and economic capacity. So the current real GDP forecast stands at 1.2% for this year, and that's quite a bit below the economy's long-term potential. Future projections, they suggest a pickup, but only if further rate reductions are implemented. Governor Tiff Macklem, he has hinted at continued easing. He says if inflation continues to ease broadly in line with our forecast, it is reasonable to expect further cuts in our policy interest rate. As Rosenberg says, the Bank of Canada's rate cut last week is just the beginning of a necessary downward adjustment to support the country's economy. He says this move is critical as it reflects a broader economic challenge that Canada faces compared to the US, and it sets the stage for potentially more aggressive monetary policy actions in the near future. Walmart Canada has announced the investment of $53 million to boost the hourly wages for more than 40,000 of its store associates. And this move comes as part of a broader strategy to retain employees, and this shows Walmart's commitment to improving working conditions for its staff. The wage increase in Canada, it coincides with similar efforts down in the US with the Walmarts there. The company there has been actively increasing investments to retain its workforce. Just this February, Walmart raised the average annual salary and bonuses for its US store managers. Also in June, the company announced it would be handing out bonuses to around 700,000 hourly store workers. Now, the timing of this wage is particularly notable in Canada here. Our inflation rate has been slowing. Generally, that eases the cost of living, but the unemployment rate has climbed now to a 29-month high. So there's a bit of a conflict there, and this suggests that despite the lower inflation, the job market is facing challenges. Potentially, this could lead to more people losing jobs as the population is growing faster than the job opportunities are coming up. Walmart Canada here operates over 400 stores across the country. It employs more than 100,000 people. And it isn't just stopping here at wage increases. They are also going to be enhancing technological support for its employees, according to this announcement. They're rolling out digital handheld devices that would enable store associates to look up items more quickly and efficiently. And that, they say, would improve both employee satisfaction and customer service. If you haven't yet checked out our Investing Academy, there is a link in the description of this video here. Also, don't forget to subscribe to our weekly Pulse newsletter. I'll put a link in the description as well. I'm here Mondays and Wednesdays with this report. As always, thank you for watching. We'll see you in the next video.